In this video, I'm going to talk about the guiding principle behind successful trading. Trading is all about the numbers. You need a mathematical formula that equals profits. So let's have a look at this. So let's say you had 20 trades and half of them were winners and half of them were losers. If you make a profit, if you have 50% or even 30% winners, then you don't need to be the best trader in the world to make money. And the way that you do that is to have winning trades that are much larger than losing trades. Now this might sound very, very basic and simple, but it's something that most traders do not do for various different reasons. But I wanted to go through the numbers here because I wanted to show you what the principle should be behind any trading system that you actually decide that you want to learn and that you want to go with. So here are a series of trades, 20 trades, and I've created the series in a way that would emulate a real life situation. So it's not just win-loss, win-loss, win-loss. It would be win-loss, win, and then a streak of 3 losses, a couple of wins, and so on, which is more like what it would be in real life trading. And I want to show you the numbers when you have a risk to reward ratio of 0.5 to 1, so that would mean that your winners are half the size of your losers. When your winners are the same size as your losers, when your winners are 3 times the size of your losers, and when the winners are 5 times the size of your losers. So let's start with when your winners are half the size of your losers. So let's say you risk $10 on each trade. And so you could see the series here. So you would win $5, you would lose $10. You would win $5, you would lose $10. You would end up at the end of 20 trades at minus $50. Now let's say you did the same thing again, but this time you had a 1-to-1 risk-reward ratio. Your reward was the same amount as your risk. You would end up with 0. And I'm keeping this simple now. I'm not taking into account any spreads, which is the fees that you pay brokers or anything like that. So just doing the basic numbers. Let's say you had 3 times the reward on a trade risked. Now you are making money with the same series of trades. After 20 trades, you would end up with $200. And if you had a bigger reward, you would end up with $400 after 20 trades risked. So this is the key thing to keep in mind when you're trading. It's the most important thing, because there are only certain things that you can actually control in trading. You can control where you enter the trade, you can control where you exit the trade, and you can control how much you risk on the trade. But what you can't control is how many trades you win and in what order you win. So you need to have a winning formula that is inside your control. So you go for the best, the highest probability trades, because of course you do want to win as many trades as possible. So you're going to go for the A grade trades. But what you're not going to do is have your profitability depend on you winning trades. Your profitability should be because you're making money, because you have a high reward compared to the amount risked on your trades. Don't take my word for this, okay? There was an article in Daily FX, which is the online sort of news website for FXCM. And this article was done on December the 7th, 2016 by David Rodriguez. And they looked through 43 million real trades to measure trader performance. And here's what they said. The majority of trades are successful, and yet traders are losing. Here is what we believe to be the #1 mistake FX traders make. So they go on to say, I mean, if you can read through it, and I'll put the link below this video. But why does the average trader lose money? We looked at over 43 million real trades, and we came to some very interesting conclusions. The first is encouraging. Traders make most money most of the time, as over 50% of trades are closed out at a gain. So a 50% win rate is very, very doable. Okay. But if traders were right more than half the time, why did most lose money? And this is the key. It's the average gain versus the average loss. You can see that the average losses are much bigger than the average gain on all of the currency pairs. We can now clearly see why traders lose money despite being right more than half the time. And very, very simple. They lose more money on their losing trades than they make on their winning trades. And they go on to actually, look at it in more detail. So it says cut losses, let profits run. Why is those so difficult to do? So when your trade goes against you, close it out. Take the small loss and then try again later if appropriate. It is better to take a small loss early than a big loss later. And if a trade is in your favor, let it run. So this sounds very, very simple, but it's not simple. And the reason is human nature. So going back to what I was saying before, the reason you will make money in trading is because you have trades that have a high reward compared to the amount you risk. And that is the key indicator that will determine if you are a profitable trader.